This conference will
Okay, so we shall discuss about the last session. What all the things we have been discussed on? So can anyone recall it? So what did we do in the yesterday's class? So can anyone recall what did we do in the last class? So most of them were there in the last class. I know that, but still, okay. So we had been done with an balance sheet related problems, and we have been seeing that how we can be able to calculate with accumulated depreciation than the retained profit value, and how to prepare and balance sheet with the debt schedule also. Okay, so today we are going to see with another concept, the one of the other important financial statement which we have to consider when we are going to refer with the documents of any business if I want to buy or merge with. So the three important statements, one is income statement, the second one is balance sheet, and the third one is very important part is the cash flow statement. So hope my screen is visible to everyone. So can
Yes,
anyone
sir, it's
confirm?
visible.
Yeah. Okay, thank you, ma'am. So the cash flow statement is a document that shows a real-time portrait of a company's gross profit and the operating expenses. That means, so how much we have been done and how much we have been earned it. So through the business for the particular period. So if there is more sales with a less than expenses, we know that it is a profit we have been made it. So at the same time, if we have been able to cover with all the expenses on the day-to-day activities, so invest in the new equipment, so pay with the dividends to the shareholders, and try to attract with the investment, getting the investment from the outer side. So these are all the positive status of a cash flow statement. So on the other end, when a financial statement reveals the negative cash flows, so it suggests the company to have enough cash to cover its daily business costs and risk insolvency. Okay, so try to keep it in a positive cash flow statements. So cash flows. Okay, so there are three things you are supposed to take care when you are going to prepare the cash flow statement. It has been divided into three parts, we can say. So the first one, it will talk about the operating activities, so which we also call it as an cash flow from operating activities (CFO). Then cash flow from investing activities. So operating activities, it is going to involve with all the regular activities what we do it on daily basis. So here it says a company's operating cash flows offers a portrait of its day-to-day operating activities, namely the income from the sales and outflows to the towards the salaries, fees, lease payments, taxes, interest payments. So all these things. So when we are able to earn more money to bear with all these expenses of the daily activities, what we do it. So this is going to show within cash flow positive way. Then the second activities is investing activities. When you are going to bring the investment, when you are going to spend more money on investing on outside equipments. So these all the things comes under the investment activities. Then financing cash flow means So what all the ways you are going to find the amount towards your business? So how do you bring the money towards to your business? So all those informations, and to the owners of the business, how much they are going to withdraw for themselves. So that it is going to show it in the financing activities. So now let us take it an example. So this is an example cash flow statement. So you can be able to see with this three types of activities. So you have to tell me that, so which statement it is going to apply for which type of activities in the cash flow statement. So the first statement says cash received from the customers. So when do I receive the cash? So if I made any sales. So if any sales activities is done, so which part of this cash flow statement it is going to get affected? Is it an operating activities? Is it an investment activities? Or is it an financing activities? So is there any guess?
So is it from investing activities?
So investment, it is like you are going to invest on an asset. So anything you are going to get back it. So here you are receiving it from your customers, means you are making a sales. So the business it is going to stay on the sales. So it is a normal activity. So the money what you are going to earn from this sales, you are going to use it for your daily activity. So which part of this cash flow statement it is related to the day-to-day activities? Is it operating, investment, or financing? Good try, ma. So this is just going to
Operating.
be related to the operating activities. So let me bring the value over here. And one more thing is, when you are going to prepare the cash flow statement, it is mandatory that you are going to show that if the money is received by the business, you are going to show the value in positive figure. If the money is going out of your hand, then you are supposed to show it a negative figure. Okay. So this amount was been received, so we are going to show it in positive figures. So the next one is cash paid for expenses. So this also it is a part of operating activities. So we are going to show it in cash paid for expenses. And this value will be minus because it is going out of our hand. So we are paying, the business is paying. So for that reason. So the next one is cash paid to suppliers. So even this also it has been paid to suppliers, means it's a purchase. And here also it is a minus value. Okay. So these are the three activities which are going to involve in the operations. So now we are going to sum it up here. So equals to sum of. So the value now, total of cash flow from operating activities, we have 17,500. So now next, cash paid to acquire additional equipment. So here we are going to invest it. So we are investing on the equipment. So we are going to put it in the investment activities. and this amount is paid, so we are going to show it in minus value. Okay, so let us see, is there anything else is it going to get added in this activities. So the next one is cash received from the investment of owner. So anything the owner brings to the business, what do we call it as? The money which is brought by the owner, we call it as what? The money which is brought by the owner of the business. So what do we call it as?
Capital.
Capital. Very good, ma'am. So this it is going to be shown in the financing activities. Why not I'm showing it as an investment? Means, see, investment means which you are going to invest it once after you are going to have some money in your business and you're going to invest it outside the business, or you are going to buy something for the business use. Okay, so here, since it is considered as an capital value, so we are going to show it in financing activities. Okay, so I have given this value. So since it is going to be received to the business from the owner, we have received the capital has come to the business. I'm going to show the value in positive figure. The next, cash received from bank loan. So we are receiving the money from the bank as a loan. It's a debt. So it is also a financing activities, and the money is coming in. So I'm going to show it in positive figure. The next thing is cash paid to the owner's withdrawal. That means it has been withdrawn by the owner itself, which we call it as. So what do we call it when the owner withdraws the money for their
Drawings.
drawings account? Very good. So since the money is going out, I'm going to show it is minus value. Okay, in between I've left out one more. So cash paid for bank loan. That means after taking the loan, I've been paid for that period. So the money is going out. So it is 27,000. So is there anything we have left out till now? No. So we have been taken with all the values. Okay. So now let us see the total of this. There is only one. So minus 20,300. So this one I have to sum it up. So it is 13,000. So the total cash flow from the operating activities is 17,500. So investment we had more. So it is a minus 20,300. And we have cash flow from the financing activities, the plus value of 13,000. So here what we are going to do it is we are going to sum it up with all these values. So net change in cash flow, what we call it as the total of cash flow from operating activities plus cash flow from investment activities plus cash flow from financing activities. So when we add up all these things, so the net change in cash flow value is 10,200. Okay. So now here it also says that in case if I have the opening balance of the cash, that is the last year's closing balance. The last year's closing balance. Yeah. The last year's closing balance was 10,800. It was been carried forwarded to the next financial year. So here the opening balance is 10,800. So what could be the cash balance as on March 31st, 2022? That is at the end of this financial year. So what could be the amount? So this will be equals to the opening balance plus that year's net change in cash flow. So whatever we have earned it out of all those activities, so total up, you are going to get to know that how much cash balance do you have it with yourself. Okay, so 21,000. So I'll be sharing this document, and in this you can also see that I've given one more problem. So try to solve this. So it has a few more additionals. So try to take a time and try to find out with the answer. So give me a minute. I'll just share it to you people through a WhatsApp. Okay, so you can be able to check with your WhatsApp group. You can be able to get to have a cash flow statement Excel sheet. So in that I have also been added with one question. Okay, so you can follow with that and try to do with this. Okay, so by keeping all these things, so let me give one simple problem. So how you can be able to bring up with the solution. So I'll try to give with a problem. Just give me a minute. I'll upload it on the WhatsApp group so that you can be able to download it and you can try it out from your side. Yeah. So I've just given, I've uploaded with an model. So it is related to the pharmacy model. So in a simpler way, I've been designed this question. So you can just check it out. I'll share the screen also right now. So hope the screen is visible. Can anyone confirm me? Is that the screen is visible?
Yes, sir.
Yeah. So you can read out. So can anyone read out for me? Okay. So I'll read out for you people. ABC company, a franchisee of an Apollo pharmacy, sells 150 stripes per day, which is called as a type A drug, at an average contribution of rupees 25% per strip, and 100 strips per day of type B drug at an average contribution of rupees 60 per strip. So there are two types of drugs, drug A, drug B. So drug A, it is going to be sold of 150 stripes per day. So where he is going to get a commission out of it of rupees 25 per strip. So here it has been taken as an assumption that in case if there is a minimality of sales of this particular type of drug of minimum 150, so you are going to earn at 25 rupees per strip. And in case of type B drug, so it is going to be minimum sales is 100 strips per day, and 60 rupees of commissions can be expected. Okay, so let us see that how much we can be able to earn it out of this. So let us go with one by one. So we can try to understand with. So Excel sheet, it is already predefined with certain informations. So you can be able to give the specifications. So with the drug A type, the commission expected is rupees 25 per strip. Okay. Okay. So here I'll just change it to per strip. Yeah. So with the drug B, we are able to collector rupees, that is a commission of rupees 60, and the volume what we are expected to sell it for one day, it is 150 and 100. So these are the things will happen in the first year. Okay. So the next thing is from the sales volume and the average price are expected to grow by 5% every year for both the drugs. That means, obviously, whenever there is an increase of the value of a good, so when the sales increases, so obviously the commission also will get increased with it. So, how do we calculate this 5% increase from the year 2 onwards? So, at least I want you people to do this 5% increment from the previous year value. Please try this. So, can anyone let me know that how you can be able to increase the value from the year 1 to year 2, and for the other rest of the years based on the previous year value with certain percentages. So, how to increase this? Please recall and let me know the answer for this. I think someone in the last session they were able to do this. So please try, even if it is a wrong, it's okay. But I want anyone to try this. Is that anyone can try? I'll give a minute of time. Okay, so let me explain it once. So it will be equals to the previous year multiplied with open bracket 1 plus the percentage of increase. So 5% and close the bracket. So that it will apply the same value, E4 value twice. So one is the previous year value plus the 5% increase of the value. So it is going to be 26. So same thing I'll do it for this. into 5%, sorry, open the bracket, 1 plus 5%, close the bracket, accept it. And even the sales volume also it is increased, equals to previous year value, multiply with, open the bracket, 1 plus the previous year value, sorry, 5%, the percentage of increase, then equals to previous year, multiply by, into, open the bracket, 1 plus 5%, and accept this claim. So you can be able to drag this to the other years for the increment. The shortcut key I use it is Control R on the right hand side, dragging the values. Okay, so these are the quantities per day and the commission earned on every unit. So for every year, the year by year, the changes in the volumes. Now, when I calculate this for the whole year, so what could be the value do I have it? So for the annual sales of drug A, so that it is equals to the commission value into the unit sold into 365. So it is 13 lakh 68,750. You're going to earn it out of drug A. Then drug B into commission into units sold into 365 days. So 21 lakh 90,000 what you are going to earn with. So this is on the year one drug A and drug B sales which happens through the sales what we earn it. The total sales of that year of adding it both drug A as well as drug B, the overall the sales is, sum it up. So you are going to have it as 35 lakhs 58,750. So now you can be able to drag this. So this is what you are going to earn. So out of this, okay. So this is all about the sales calculation for the year on year. Okay. So the next thing is the calculation of expenses. So let's see that what all the information do we have it with this. So to operate the franchisee, it needs to have a 750 square feet of a space for the shop, which is a lease rental of rupees 100 rupees per square feet per month. The rental contract is for 5 years, and the deposit amount you are going to pay it at the initial, it is going to be at 10 lakhs. Okay. So now the rental expenses what we are going to bear it on every month into the year wise, so that it is equals to 750 square feet into 100 rupees per month into, this is going to give you 1 month expenses, but we are calculating for the year wise. So for the total annually rent expenses what we are going to bear it, so that it has to be calculated 12 times. So since it is monthly, it is 12 months. So that is 9 lakh rupees what we are going to bear it. So let us see that is there any increase of the rental amount. So we don't find it anything related to the rental increase. So it remains the same for all the years. So I'll take the previous year value and drag it. Okay. So the next thing is the salaries. So let us see what is the information do we have it on this. A one-time renovation of premises worth rupees 20 lakhs will be needed to be incurred at the start. That means at initial stage you are supposed to spend 20 lakhs for the renovation purpose, and the deposit of the amount of 10 lakhs you are supposed to give it. So let me put up these values. So deposit for rent is 10 lakhs. Then renovation cost is 20 lakhs. So the total investment at initial stage, what you are supposed to bring it is the sum of these two. So that means there is an investment has happened. That is nothing but the capital what you have brought to the business is 30 lakhs. Okay. So we have given this information. Next, it requires personal costs are rupees 80,000 per month. So that is nothing but the salary expenses. Okay. So requires personal cost, that is salaries, are rupees 80,000 per month, and there is a inflation rate with the salary. So every year it has to be increased with 7%. Okay. So the salary is 80,000. So I'm supposed to calculate it. So I'm supposed to give it with the equal sign. So equals to 80,000 into 12. So every month 80,000. So per year it will cost what? 9,60,000, and on this there is a increase of the salaries for every year at 7%. So I'm supposed to calculate the increase, that is the previous year, into, open the bracket, 1 plus 7%. So this is the function of formula we are going to use it to calculate the increase. Okay, so the same thing applies to the other years. Next, other operating expenses. So the next line says other operational expenses are expected to be 25% of the contribution generated for that period. So that means whatever you have been generated, that is the our annual sales value, on this there is a 25% operational cost has to be applied. So multiply the annual sales value of that year into 25%. So this is what the operating expenses value. So the next thing is interest expense. So the interest expenses will be, so here it says the tax rate is 35%, that we will see later. So tax losses cannot be carried forward, the initial investment. Okay, sorry, the tax losses cannot be, I'll put it in the bracket, cannot be carried forward. So the initial investment, that is the deposit under renovation value, is funded by 60% on the bank loan, where the interest percentage is 12%. The remaining should be funded using equity value. Okay, so if you see that we have been taken this deposit of the rent plus renovation cost, so total capital, so I don't take it as an investment, the total capital is 30 lakhs. So on this there is a amount you brought it, it was 60%. Out of 30 lakhs, 60%, that comes to 18 lakhs, brought it through loan, and the remaining amount, it is through equity. Okay, so when you are going to say that you have been taken the loan, the interest expense has to be paid. But here, let us see the statement whether we are supposed to pay it everything at once, or it has to be paid annually equally, or it has to be calculated with any specific method. Okay, so let us read out. The debt has to be repaid at the end of the 5 years in lump sum. Okay, so that means up to 5 years you can pay only the interest amount. At the end of the fifth year you are going to pay it at a lump sum. Okay, so the expected return of, The expected return on investment is 20%. Okay. So now let us see the interest expense equals to on 18 lakhs. So I'm going to freeze it because it is going to be the same value for all the years into 12%, and I freeze this also. So 2,16,000 the interest amount we are supposed to pay it every year on 18 lakhs. So the profit before tax will be equals to the annual sales value minus the sum of all these expenses. The next thing is the tax to be paid on the profit before tax 35% into 35% which is fixed. So same thing is applied for all the other years. And finally, the profit before tax minus the tax will give you the current profit after the tax, the net income. Okay, so we are prepared the income statement in this ways. So we should be able to read out with each and every point so that we can be able to understand easily and implement the calculation on the certain components. Then finally, we are supposed to prepare the cash flow statement. So here the cash flow statement, it has been prepared as a free cash flow statement format. So where we are going to talk about how much initial investment we have been brought it to this business. So that is the capital amount. So it is 30 lakhs, but is it this amount it is going to be with us or it is going out of my hand? So this amount, say I'm paying a deposit of 10 lakhs and I'm spending it on the renovation. So the money is going out. So for this case, it is going to be in minus value. The next, I have received a loan, that is the debt is raised. How much? 18 lakhs. That means the money has come to the business at the starting of the business. For the first year or before starting my business, I have taken this loan. So now the same thing, I'm not going to pay it every year with equated annual installment. I was paying only the interest amount, but I'm going to pay it at the end of the period, that is on the fifth year, with the whole amount. So that is the money is going out of the business. So it is minus 18 lakh. The next thing is the deposited money of 10 lakh is going to come back to us at the end of the fifth year. As we all know that when we are going to pay anything on an advance, for the rental purpose. So once the period is completed, of rental period is completed, so it is mandatory that we are supposed to receive back our advance amount. Okay. Then finally the PAT value is nothing but the profit after tax value, which has been taken from the income statement, the last line item. So take it for all the years. Then the total cash flow will be the sum of all this component. So do not leave any component which is empty. Take it into the consideration, because in a different years the different values are going to get applied. So take it even if it is a blank. Okay. So drag it for the other years. So this is what the total cash flow we have it. Then finally we are supposed to find it the IRR, that is internal rate of return. So internal rate of return means what is that you can expect the return of investment from all these activities. So here in the problem I have been given as the expected return on investment is 20%. Okay. So whether it is going to give a 20% or more, then it is suggestible to take this franchisee. If it is giving lesser than that, then it is not suggestible. Okay. So let us see with it. So IRR calculation will be by using the IRR function. So here you are supposed to select with the total cash flow values. So total it up and check it out. So it gives a 32% of the rate of returns. So is it now is suggestible by a financial analyst to go ahead with this franchisee or not? So we were expected with the 20% and it has crossed with 20%. That means we can be able to suggest to this business owner to go ahead with this franchisee. Okay. So I'll share this answered document also to you people, but still you try it out to solve it on your own. Okay. It is going to be only for your reference purpose. I am going to share this. Okay. So refer this and do it. Practice it from your end. Okay. So this was one of the example or sample of the problems. How do you uh, clarify it based on the calculations what we have done till today? Okay. So I'll take a 5 minutes of break and get back to you people, and I will also give one more kind of a problem, so or the situation, so that you have to try to solve it. Okay. So let us get back at 7:41. Thank you all for being online. Can anyone confirm me that you are able to hear me?
Yes, sir.
Yeah, thank you for the
Yes,
response,
sir.
ma'am. Yeah. So I'll share it one more problem. So and I'll try to explain it on it. So you can check it out in your WhatsApp group. I have been shared one more case study, so which is called as a Toyota case study. So when we are going to buy a franchisee of an automobile showrooms business, so what all the things that will be involved in that, so that you can be able to just go through with it. The similar kind of the case study it is. I'll just share it on the screen so you can just go over through on it. Yeah. So this is the model which have been created. So you can see here. So generally you don't find it to be predefined or templated one, but we have made it in a simpler way. You have to do it with the value calculations, but only the thing is you have to understand with. Okay. So it is very simpler way we have been added this. So you can read out with the case study, and the values also are given over here. Only the thing is you should be able to know that where to add this values and how to calculate it. It is in a simpler way. Okay. So add it. So do the calculation of the sales, what happens, and bring that value over here in the income statement, and then you are going to prepare the cash flow statement. It was the same way how simply we have been created and calculated in the previous problem. So bring it till here. Okay. So let me know the IRR, the internal rate of returns. So what you are going to get it. Okay. So this will be your assignment for the week, so that I want you people to try with this and bring up with the answer. Okay. So which is there available on your WhatsApp. So please try. So anyway, your people are getting with the recordings also. You can go through once again with the recordings. So try with, and we can be able to solve it. Okay. So by this we are going to end up for this week. So we'll meet up in the next class on Monday onwards. Okay. Thank you all. Have a wonderful weekend.
Thank you, sir.
Thank you, ma'am.